Rashad touched on this. No, go right here to the ETFs. We want to make sure we're being nuanced about this. Putting your money into the brokerage isn't investing. Here's where some of your money should go into. Number one being ETFs and growth stocks. What is the ETF? Our exchange traded funds. Basically, you look at it like you're going to a mall. If your favorite store is inside of that mall, you can kind of similarly look at your stocks in a similar fashion. So it's like a basket of stocks. One thing it does for the truck driver, for the traveling nurse, for the lawyer, for the busy person, the busy parent, the mom, the teacher, the person that don't have a lot of time to sit around, but know you should be investing. This is what you want to consider in terms of kind of taking some of the legwork that should be done, because you should know what you're investing in, but it kind of takes some of the legwork out of it for you so you can kind of invest into these basket of stocks, knowing that you're investing in quality, knowing that you're investing in blue chips, knowing that your money is going into the right vehicles that will serve you best long term. Okay, and so that's where these ETFs and growth stocks kind of come into play. Speaking of growth stocks, they have a different purpose. So you need to think to yourself, have you been investing? Like Shadi said, we got so many people still not yet invested into the market. And so we know we got more work to do. That's why we don't rest on our laurels. That's why we showing up every day, despite all we got going on, because we got to get you here. The growth stocks will allow for some of you to have a little more growth, to have a little more velocity into your investments, getting those gains that, say, a dividend stock may not get you. And we'll talk about dividend stocks later, but growth stocks are oftentimes not profitable, not yet profitable, en route to being profitable, but their whole aim and focus is to reinvest in a company to grow it as fast as possible. And so that's another vehicle and mechanism for you to consider when investing. What do I put my money in? You should consider an ETF, a basket of stocks. Some that you might know on Vanguard, for instance, would be VTI. If you rock with me, you know we go down through there. That's one of our number one holdings. VTI. You have VOO. You have VIG for if you want that information and growth. You have VUG. You have a variety of ETFs that are going to do the heavy lifting for you inside of those basket of stocks that will set you on your way. Then you have the growth stocks. Some of you may be familiar with the NASDAQ, the QQQ, things that have some of our best tech companies inside of them that gives you that growth. You see, when Troy helped you guys hit the micro strategies out the park, well, if the options did what he helped you guys do, what you think the stock did? You get those kind of growth opportunities in Nvidia going up 200% in a year, in a Meta, in a Google, when you talking growth stocks, because their aim and focus is just a tad bit different than other entities and vehicles to invest in.
Yeah, I think, and let's stay on this for a minute too, because even to break it down on a very ground level as far as the difference between index and ETFs, right? And I love to get your perspective about how we've said before, like an index fund is kind of like a supermarket, the whole entire supermarket, right? So it's like the S&P 500. That's something that people should know if you're investing to the stock market. Standard & Poor's 500. A lot of people have heard of that. They don't know what it is. Like that's 500 companies, right? That's like a microcosm of the stock market, which companies from the automotive industry, energy, tech, all of that, and they all come together. So most people consider like an index fund as the safest way to invest, because that you get all of those 500 companies, or the Russell 2000, you get 2,000 companies, where the ETF is like a specific aisle inside the grocery store. So it's like you got the Indian aisle, or you got the Mediterranean aisle, right? Where you just specific. So it's like if we talk about Nvidia a lot and we talk about computer chip stocks, well, there's a ETF called SMH, which only specializes in computer chips. So the benefit with the ETF to me is that if you're not fully confident, you want to invest in one sector, but you're not fully confident in putting all your eggs in one basket with one particular stock, then you get the all-star team, right? You get all of those different companies, right, which will make up that ETF, it's not going to do as well as that one company if that one company strikes it out the park. But you've hedged your risk, right? Because now you've got 10, 15 companies, but they're all in the same exact industry, as opposed to just one leader in that industry.
Yeah, it's kind of like that table strategy that we spoke about years ago, where it was like, all right, I'm going to build my investment table on ETFs. Or if it's SMH, where it has all the semiconductors, I can have SMH as one of my legs. If I would individually want to invest in NVIDIA, that can sit on top of the table. If NVIDIA rises, SMH is going to rise, right? Because of the allocation. And that's the beautiful thing about ETFs. The percentage that is invested in these companies changed. So when TSM was running, TSM led the SMH ETF. NVIDIA has taken over the past 2 years. Now NVIDIA is the number one allocation inside of estimation. So that's beautiful. It actually is investing for you when you don't have to. Yes, the upside isn't as great, but the downside isn't as volatile as well. And so that's important to know. You talked about growth stocks. A lot of people always hear growth, they hear value. There's a difference, right? Growth, you brought up some of the mega cap companies, the Mag 7 you talked about. But the value stocks are a little bit different, where it's like they're trading below their value, but they have upside, which could mean potential higher growth. So if I'm a beginner investor, am I looking for growth or am I looking for value in the anticipation of a higher upside?
These are things that your age, your personal goals, these are those things that determines that. Okay, if you're younger, for example, you might look at a value that is got a little growth to it. If you are at a retirement age, if you don't want the volatility, then you may want something that's slow and steady. You may want something that's less volatile, so that you can rest easy at night knowing, yes, I'm invested, but I got a medium to low risk. I can keep my nerves in check. Versus the younger individual that's investing at some of my 18-year-olds that's in the money team, 24-year-olds. Some of you guys are able to get in some of those fast moving cars, if you will, that has a lot of runway ahead of them. So you might want to make sure you just simply looking at your situation, your age, your income, where you're at on your own journey. And these are the factors, or some of the factors, that come into play when you think in value versus growth, or when you want to do a mixture of the two. And I like what both of you guys said about the SMH and the aisle. Guys, I'm an athlete, and I use sports to teach the stock market. And so you want to look at the ETFs, and like Rashad said about the SMH, think about super teams. Think about having LeBron, KD, Steph, Wemby, and Carmelo on the same team. Think of owning the best 500 companies, or the best top stocks in that sector, in that mindset, when it helps you know, I got some of the best of the best. I got the best in class. I have the things that should do right by my money long term. Always highlighting long term. So no, that's a good one with the value and growth, Troy.
Yeah. If somebody's like still trying to figure out, I'll give you an example. A company like Tesla, right? Like you look at if you look at Tesla's chart over the past 2 to 3 years, maybe 5 years, we can go back 5 years, and you watch the movement, the volatility. Rick, this is a growth stock. We can see it has a long runway. It trades volatility, but we're in it for the long term, right? If you look at a value stock like a Verizon, I remember investing in a Verizon 10 years ago, and I'm just sitting there like, this thing's trades sideways forever, right? But it does give a dividend, right? So there's value inside of that company. So it's a strong company. It does move up, but it doesn't move as quickly. So those would be like the differences if you're thinking value versus growth.
And then also, it's like for even the index ETF individual stock, like sometimes you have like Apple, right? It's a company that I'm invested in on an individual stock. I'm invested in that company. And then I'm invested in the S&P 500, which Apple is a part of the S&P 500. Then I'm invested in a specific technology ETF called XLK, which has I think like 13 stocks in that. So, and Apple's one of the leading holder in that as far as the percentage makeup. So I'm in the Apple, from the large ocean to the smaller pond to the stream, right? So I have exposure on every level, but sometimes when you're in a company, that's a way to kind of look at it as well, where it's like, okay, I like this company, but I wanna have some level of protection and some diversification where I can get other companies as well. So
Mhm.
that's a strategy too. It's like, own the company, then own the ETF that the company is in, then own the index that the company is in. Most of the time, if it's like a good company, they're gonna be in the S&P 500. They're gonna be in a lot of like
Mhm.
Apple, Microsoft. These are companies that are leading the world.
Mhm.
So they're gonna be in QQQ. They're gonna be in XLK. They're gonna be in the S&P 500. They're gonna be in VOO. So it's a lot of overlap. A lot of times you'll see a lot of overlap in that. So that's important for people to understand as well.
It's kind of one of those theories when you tell people follow the money, right? Like if something's been added to the S&P, that's because a lot of money is being poured to it by hedge fund. People are investing in that company to now put it on that index. So we just saw Palantir get added to the S&P 500. Well, there's a reason. Palantir had an amazing year. It was up 279%. Now that's added into the S&P 500. So follow the big money. I'm glad you brought up Vanguard. These institutions don't invest into these companies for no reason. It's because
Right.
they're trying to make money as well.